Asia Pacific started 2026 as the world's busiest IPO region. In the first quarter, it recorded 107 listings, raising around $20 billion, more than any other region by both deal count and proceeds.
We have a really big year for IPOs with SpaceX, OpenAI, Anthropic, basically the leading names in AI tech in the US. But analysts are pointing out that there's much more volume here in Asia, but a smaller market capitalization relative to the mega IPOs that we're seeing in the US.
Hong Kong, Mainland China, and India are all major listing venues, but each is powered by a different source of demand: offshore liquidity, policy-guided capital, and domestic retail participation.
Last year, Hong Kong saw more money raised in IPOs on the exchange than the New York Stock Exchange and also NASDAQ. And India has also been up there in recent years. But because of the large user base population, you do have a lot of money and potential for these markets to become much more active.
But IPO activity only tells part of the story. In several Asian markets, strong fundraising hasn't always translated into lasting momentum after companies go public.
On average, it's sustainable, but I have to say that the return dispersion tends to be huge across different companies and sectors.
So, if Asia's IPO market is booming on paper, why do some listings struggle to keep momentum after going public? And why does it depend so much on where they list? Hong Kong shows the strength and the weaknesses of Asia's attempt to become a global IPO powerhouse. In the first quarter, Hong Kong listings accounted for roughly 35% of global IPO proceeds, more than US exchanges and far ahead of mainland China's A-share exchanges. That translated into about $14.2 billion, making Hong Kong the world's top IPO venue by funds raised. But its real advantage is not just the money raised at listing. It is the access Hong Kong gives Chinese companies to offshore capital, international investors, and a liquid secondary market. A key part of that is cornerstone investment, where large investors commit to buying shares before an IPO begins trading.
If we look at cornerstone subscriptions, it accounts for around 40% of the new capital raised, and among that, about 2/3 are coming from global cornerstone investors and about 1/3 coming from domestic investors.
You're going to get more US tech listings in the US, and you're going to get more Chinese or Chinese-associated, affiliated tech listings in Hong Kong. Look over the course of the last 2 years, there has been an absolute flurry of new issuances.
The Connect program is really important for the Hong Kong markets in terms of overall trading volume and participation because it increases the access of mainland Chinese investors.
That access shows up as southbound inflows, mainland capital entering Hong Kong via Stock Connect.
Southbound inflows have been the largest source of inflow to Hong Kong market in the past years. Last year, through the southbound channel, there was over $180 billion net buying. We continue seeing strong momentum. Close to $40 billion net buying have accumulated year to date.
But strong liquidity does not always mean lasting support. As of June, about half of the companies that had listed in Hong Kong since January 2025 saw their share prices fall over the previous 3 months. Over the same period, Hong Kong's broader market was only slightly lower, while a global index of newly listed companies rose by more than 10%.
For some high-quality companies, especially ones that are unique, say in the AI space or biotech space, they can deliver high earnings growth or have a strong growth outlook. They tend to have more sustainable outperformance or even longer than 6 months.
Recent large deals show both sides of the model. CATL, the world's largest EV battery maker, raised about $4.6 billion in Hong Kong in 2025 and jumped on debut. Proof that Hong Kong can still attract global-scale capital for marquee Chinese companies. But Ant Group showed the risk. In 2020, Ant was set to raise about $34.5 billion through a dual listing in Hong Kong and Shanghai before regulatory intervention in China halted the deal.
So the sudden suspension of the Ant Group IPO really reminded investors that no matter how mature your market mechanism is, the risk is still regulation from Beijing.
Hong Kong's IPO machine can generate scale. The harder question is whether it can keep companies supported after the listing day excitement fades. Mainland China's onshore IPO system is built around a different idea. Rather than competing primarily for international listings, it is designed to mobilize domestic capital for companies that fit China's industrial priorities.
At the first International Import Expo back in 2018, Chinese President Xi Jinping announced the STAR market. The entire country was essentially mobilized to focus on this new exchange that was supposed to be another attempt at a NASDAQ-style exchange to support Chinese technology and new innovation.
As of June, the STAR market hosted 609 listed companies. Nearly 40% fell under the new generation IT category, making it the largest segment on the exchange. That focus is now translating into high-profile listing candidates. Unitary Robotics, a Chinese developer of quadruped and humanoid robots, passed a key STAR market listing review in June, making it one of the most closely watched robotics IPO candidates. Memory chip maker CXMT has also passed review, with plans to raise about $4.3 billion. This would make it the second biggest IPO in STAR market history and the largest IPO on mainland China's A-share market this year.
There's this range of new innovation, new Chinese technology that China is trying to support through the STAR market because they can sometimes fast-track the listings of these IPOs. It's also an attempt to make their stock market more mature, because a big difference with the mainland Chinese stock markets in particular versus other parts of the world is that the majority of trading is still done by retail investors who might not want to stay invested for a long time.
There is a stark differential between how capital formation in the equity markets is being used in the United States, market cap, wealth creation, which sure can be an objective. But with the more shotgun approach that China is taking with regard to the numerous groups that are now going public, it's about being able to create that resiliency locally throughout the entire tech stack.
That makes mainland China's IPO model very different from Hong Kong's liquidity-driven market.
Their review is not focusing on company fundamentals, but more focusing on like the data security, national security considerations.
India represents a third IPO model, one powered by domestic growth expectations and a rapidly expanding base of local investors. That has made India one of the world's most active IPO markets by deal volume.
Indian IPO market has proven to be extremely resilient. That has been driven to a very large extent by investors being excited to invest in new opportunities, both in new age businesses as well as traditional businesses, and a lot of investment flows coming through domestic sources, both institutional as well as retail.
According to the country's markets regulator SEBI, India's number of unique registered investors rose to about 136 million as of late 2025, up from around 40 million 7 years ago. That broader retail boom has helped fuel demand for new listings. The pipeline is also large. More than 190 companies were either SEBI approved or are awaiting regulatory clearance to list in 2026.
I would feel there is certainly an appetite for large IPOs. And these are really big brands, very well known amongst the investor fraternity in particular.
Regulators and market participants have warned that new investors may be more vulnerable to hype, especially when familiar consumer brands come to market.
A lot of initial public offering subscribers seem to be exiting within 1 year, and that number could probably go, based on some estimates, as much as 70%. So there are two very real things happening in parallel. Indeed, there has been some speculative element, some day trading element, and so on. But at the same time, there is a very long-term investor class that seems to be believing now in the equity story in India.
Indian authorities have stepped up investor education efforts, urging investors to focus on company fundamentals rather than market noise. Asia's biggest IPO markets show that there is no single path to scale. Each model has produced major listings, but each comes with a different trade-off.
For the international institutional investors, just the level of trading volume, the market capitalization, the participation in the markets that makes Wall Street what it is, being very large and liquid and a good place for price transparency, price discovery, that Asia is still trying very hard to catch up with.
As the next wave of mega IPOs approaches, one lesson stands out. Raising billions is only the first test. The harder one begins after the bell.